Hey guys, John Paulamy here, Actionable Intelligence. Today's Saturday, January 25th, 2020, and this is the weekly market update. So, first things first, let's talk about, in the reality check, let's talk about hysteria, panic, lack of information, extrapolation, and linear thinking. So, we're going to talk about a little bit about this coronavirus that's freaking everybody out. We've seen some pretty big moves down in the oil markets over the last week or so, and in the base metal markets. This is being attributable to the fact that the spread of this particular new coronavirus, and coronaviruses are common. We'll go into that in a minute from the CDC website, but this is a new coronavirus. So there is a lot of speculation, there is a lot of lack of information, and there is a lot of the press getting in there and doing what they like to do, which is make something more than it is. Now, I'm not an epidemic expert. This is not my circle of competence, but I am going on previous information and odds and previous outbreaks of more severe viruses than this, and what the real effects were and what really happened. So the information I'm going to talk about here is basically off the CDC website, links provided as always. Common human coronaviruses, and it shows the different types, usually cause mild to moderate upper respiratory tract illnesses, like the common cold. I'm getting over one myself. I have had a head cold for the last week. It's not been, didn't threaten my life. It's been inconvenient, but I'm now recovering. Now, there are two other human coronaviruses, the MERS and SARS viruses, which we've heard about before, and these are more lethal, and they have been known to frequently cause severe symptoms. Basically, what ends up happening, you get secondary infections like pneumonia, and then if you're susceptible, you're immune compromised, you basically can die. So this 2019 coronavirus is novel coronavirus because it's new, and panic is setting in, I think, because of a lack of information. And, with social media, you see these people just falling over in China onto their face. And people are looking at the movie Contagion with Gwyneth Paltrow being patient zero and kind of thinking, well, this is what this is. Now, I'm not going to get into the likes, dislikes, or merits of the Chinese dietary habits of eating koalas and bats and snakes and salamanders, but it appears that this had something to do with it, and that this particular virus has now made a jump from the animal kingdom into humans. But from what we understand, the deaths that have happened have mostly been elderly and immune compromised people. Again, we don't know the full extent of this. We don't have all the information. We also know that the Chinese medical system is not as advanced as the United States' medical system. And something I want to point out here at the last bullet point here, and no one even cares about this or even talks about it on a year-to-year basis. You can go, I'll put the link on the CDC website. 12,000 to 60,000 people in the U.S. alone die every year of regular flu. That's according to the CDC, and no one panics or freaks out. Because typically what it is, like I said, elderly people or immune compromised people that have HIV or something like this, where their immune system is already compromised. Now, that is not to minimize this particular virus. Like I said, I'm not an expert on epidemics, but we have experience with MERS and SARS, and these are far deadlier than regular influenza. And we don't know where this novel coronavirus fits in between MERS and SARS and the common cold. It's going to probably be somewhere in between there, but we don't know. We don't have, vaccines or treatments for this, so there's a lot of misinformation, lack of information, and unfortunately, the press does what it usually does, is creates hysteria. There was an article in the New York Post, which I'll put a link to, which I thought was very good, that tried to put this in perspective. And these are quotes from the article. It's talking about, and what I put here on the title is, if it bleeds, it leads. This is what the press likes to do. They like eyeballs. They're advertising supported. They want hysteria. They want sensationalism, not facts. So let's just point out some of the blurbs from this particular article. Heterosexual AIDS, Ebola repeatedly, and there's an Ebola outbreak going on currently in the DRC and surrounding countries. That's not really reported that often. H1N1 swine flu that was actually vastly milder than the regular flu, and especially severe acute respiratory syndrome, SARS, in 2003, which we will talk about more. Once you start debunking mass hysteria over outbreaks, it gets easy because the same pattern repeats itself. And it goes on. I really encourage you to read the article that I'm going to put a link to because it'll kind of calm you down a little bit if you're nervous about this. Been through this before. Do I think this is the Spanish flu after World War I and tens of millions of people are going to die around the world? I don't think so. Especially, this is going to be a heavier impact in less developed countries that don't have as great of medical facilities and responses that we have in the West, especially in the United States. One of the things that I found was interesting, this last particular blurb from the article, it says, it appears that, like flu, Wuhan usually kills through often treatable secondary infections. Well, treatable in the West. You'd be surprised at how many potentially deadly diseases, malaria, TB, Americans get that wreak havoc in much of the world, but kill essentially none of us. And this is true. I mean, we have people want to bag on the U.S. medical system. It's expensive and it doesn't cover everybody. But let me tell you something. This is the place to be if you do get sick, okay? And you're going to get, or at least have, for the most part, have availability to the best medical care. I mean, there's one woman that came back from China already. She's had this, it manifested itself when she returned from China, and she's already in stable condition. I think she's a lady in her 60s, I think in Washington State or Illinois, I can't remember. So if you're not immune compromised, if you're not a small child or an elderly person, your chances of, well, actually getting this are small probably. And if you do get it, you'll probably just be like the flu. So that's not to say it couldn't change, but what are you going to do about it anyways? Is worrying about it going to change anything? I mean, are you going to sequester yourself in your bunker or in your house and tape all the seams up and just sitting there until this? I mean, you can't really live like that. So, but we do look at this because we have to talk about it because the impacts to what's happening in the oil market, because obviously if you're locking down all these cities, the thinking appears to be in the market at least that oil demand is going to go down, therefore we're going to have this, overabundance of oil supply, and then people are front running that. So this has happened before. This is the U.S. crude prices during the time of the SARS outbreak, I believe it was 2003, and you could see that when how much oil dropped, about 40% overall, $10 a barrel from 37 or whatever it was. I don't even remember this. This is how insignificant this is. No one even remembers. So here's the danger period of SARS, and here was the drop that was supposedly attributed to it, but there was other things going on here. This was a time of when we were preparing to go to war with Saddam Hussein again, and they were filling up the supplies before. So I'll put a link to the tweet feed that talks about this. What I'm trying to tell you is I think this is temporary in nature. I think the things that we've talked about before, this will probably blow over. It'll eventually be contained, or it will be recognized as not being that severe. Remember, 12 to 60,000 people in the U.S. alone die of the flu every year. Tens of millions of people get the flu every year. Smaller percentage of those particular people are hospitalized, and even smaller percentage of those people actually die of the flu. And like I said, it's particularly elderly people and immune compromised people. And I think that's what we're probably looking at here. So if traders are in fact selling out oil positions because they think there's going to be a massive drop in demand that's going to do this, then we can expect a bounce back? Or is this in fact covering for the fact that weak economic growth around the world is finally manifesting itself in this oversupply of crude oil, and now the price is dropping? I think it's the former. I think it's traders. It's a temporary phenomenon, and I think it will bounce back. Remember, nothing's changed on the monetary front. Massive amounts of currency units are being printed. We are seeing leading economic indicators around the world pick up. This appears to be a temporary bump in the road, and I think it's a buying opportunity if you share my view that we will see nominal economic growth around the world due to all the money printing. We've talked about that many, many times in the past in these videos. This is unanticipated. Now, this could get out of control. Maybe this is the Spanish flu epidemic of 1918, and tens of millions of people are going to die around the world. I don't think so, but it remains to be seen. But I think that with oil prices really coming down, a lot of base metal prices coming down, because everybody thinks economic growth is going to contract now, I think this presents itself maybe not. We'll get to peak hysteria, and then we'll realize that this thing's not as bad as we thought it was, and that will be the time to buy. I'm not saying buy Monday morning, because you're probably looking at additional weakness, because we really don't know the full effects yet. And as it continues to manifest, and as time goes by and it doesn't explode, and we have mass deaths, it's not the black. We realize it's not the Black Death, then that will be the time to buy. But I don't. Maybe that's not next week. Going on, talking about oil bull markets. This is from a tweet storm from Eric Nuttal, one of my favorite analysts on oil, especially Canadian low market cap oil and gas producers, with a focus on free cash flow yields. And he's pointing out some bullet points here about the makings of a multi-year bull market for oil. Now, this is what I'm anticipating, and a lot of these reasons are exactly why. I'll put a link to the tweet storm. He goes through his thinking. You can read it. I suggest you follow him. He's very smart. I get some of my good ideas for my exploration and production company picks from him, because he does excellent free cash flow yield analysis of these Canadian companies, which are the most beaten down of an already beaten down industry, which we've seen a turnaround already until this recent oil price dive due to this virus outbreak situation. So getting back to the slide, the makings of a multi-year bull market for oil. Incessant U.S. production growth negatively shaped the energy market narrative for the past 5 years. That's exactly what we've been saying. All the shale story sucked the oxygen and investment out of the room for everyone else, particularly offshore and other conventional type plays, because the hundreds of billions of dollars that were thrown at shale allowed an explosion in the growth of production of shale and forced the oil price down and made a lot of the other investment decisions non-economic. That's now changing. We've talked about that over and over. I think we've passed peak shale. Yes, there'll be additional growth, but I'm talking about from an investment story. I just don't think that it's becoming obvious to everyone that looks at it that the shale story doesn't really work economically for everyone, and it's going to have to be rationalized to the point where only people that can really do this on a cash flow positive and profitability basis will be in the picture, and that's going to lead to investment slowing down, which is already happening, and it's a red queen's race because of the decline rates. We've talked about it, this ad infinitum. If you're not shoving increasing amounts of money at this, you can't even maintain production, much less grow, and that's what we're seeing. We're seeing it. The growth in production slow down. It will eventually roll over and we'll be into declines. Once that narrative and that mindset sets in, there's going to be a relook and a revaluation of other non-OPEC oil areas, if you will, i.e. offshore. And that's happening. We will talk about that in another slide coming up. So, just talked about this. U.S. shale growth is now massively slowing due to financial constraints. This is an extremely important development for oil markets. It is the most important, in my view, in the short and midterm. As U.S. production no longer fully satisfies global demand growth, other regions need to make up for the shortfall, or else the market will enter into a deficit. That is exactly correct. And when that narrative seeps in, I mean, you have IEA and EIA and Rystad still talking about, this huge growth in shale production going out years. That they haven't realized, I think, what's happening. And when those folks change their view, then the market as a whole will absorb that and change their view towards shale. In 2020, global offshore production, that's 1 in 4 barrels produced globally. Actually, it's probably 30%. Will enter into a multi-year decline, and OPEC has limited spare capacity. Yes, there's not been a sufficient investment, although it's picking up offshore now. But that has 5 to 7 year runways. It's not something you just flick a switch and, like shale, where you can just dump a bunch of rigs and see production increases in 6 months. We see supply-demand scenario lasting 5 years and suggestive of a much higher oil price. I agree. I think that you're going to see continued demand growth, plus 4 to 6% depletion means you need to find and bring on an additional 7 million barrels of new oil every year. That's not happening. Matter of fact, last year, I believe it was reported, we use 36 billion barrels a year at 100 million barrels a day. It comes out to 36 billion barrels of oil used a year. We only found 4 billion barrels. That doesn't work long term, and that's been consistently like that, where we've used considerably more oil than we've found. And at some point, that is going to become a problem. With stocks discounting $50 a barrel, we see compelling upside even without further upside in oil price. That's exactly right. If you've been following the newsletter, if you're in the newsletter, you know that we have an excellent Canadian company that at $50 to $60 a barrel cash flows enormous amounts of money. They are currently paying down their debt, and they just recently refinanced their debt even further out, so they are in no danger of going bankrupt. I think there's more risk to higher oil prices in the 3 to 5 year term than there is to the downside. That's my view. So let's talk about the aforementioned offshore. This is from an article that was in, I believe, Offshore, one of the offshore trade periodicals. These are all quotes from the article. Obviously, I put a link in the show notes. I suggest you read this if you are interested. We are going to really start picking up our analysis and probably adding new names to the portfolio formally now, as this upturn has now turned and is accelerating. From the article, with reduced project economics, lower cost structures for oil companies and their suppliers, the economic potential of prolific offshore wells has likely never been better. A new growth cycle is emerging. Offshore rig utilization is quickly increasing, with utilization for marketed floaters at 80% and marketed jackups at 83%. This compares to 68% for both at the trough. Now, we've highlighted this month after month as we get the data from Basso Analytics. We've seen utilization rates go up. The thesis being once you crest the 80% level in utilization, you typically begin to see day rates start to climb. That's what's actually starting to happen. We're seeing day rates go up. The other thing I would offer is that there has been several announcements by some of the offshore drilling companies. They've also been able to refinance a lot of their debt and push it further out. I believe Valaris and Transocean have recently made those announcements. We'll dive into that more in upcoming videos. But that gives them more runway for this upturn to still be around to enjoy it. More day rate gains are ahead as a rig market short squeeze is likely in the coming quarters. That is completely 180 degrees different than the current narrative, which is we have this oversupply of rigs still, no one's drilling, people are trying to just get their rigs to work for these low prices. That narrative appears to be changing. Recent day rates for floaters in the Gulf of Mexico jumped from $175,000 to $200,000 per day and are poised to reach the mid-200,000s in the near term. Now, that's a far cry from the highs back in the boom, but we are going in the right direction. Further commentary from the article. The offshore drillers are suggesting customer interest is at the highest levels in 5 years. Direct negotiations outweigh open tenders, and thus publicly available demand is understating the real outlook. The back half of 2020 appears especially strong. So what's happening is, apparently, there's a lot of discussions going on, but they're not publicly known, and I think the market may be surprised in the second half of 2020 when these things are disclosed, when they're signed and disclosed. We showed it in last week's video, the amount of forward investment decisions has been increasing last year by, I think it was 40 or 50%. It's poised to increase this year. So if you're going to commit money to work, then you need to start negotiating with all your service companies, and that's going to start drying up the supply of these rigs. We now believe industry activity is poised to accelerate higher. We expect a squeeze on engineering capacity, on offshore assets, and on crews to become very apparent as 2020 unfolds. And this is the investment thesis. We had probably the worst offshore oil drilling, service, support, depression in the history of the industry. That has been acknowledged by many market players. There were quite a few bankruptcies. There were quite a bit of consolidations. There were rationalizations of rig fleets. People left the industry. People move on. Hey, if you're working in the boom times and you're knocking down 120, 130 a year, and then it dries up and you get laid off, you don't sit around and wait 3 years or 4 years for the recovery. You go get another job. You start a business. When they call you back, you're like, hey, I don't know if I want to do this. And I've seen the same thing in some of the things that I've worked in construction around wind turbines based on the PTCs. When the PTCs dried up several years ago, everybody left the industry, or quite a few people did, and you couldn't get them back. So you got to start all over with a bunch of young guys, not as experienced. That's just how it is. So you couple that with the fact that you don't have as many service boats, engineers, crews, rigs. This suggests that we could see a surprise on the upside on this recovery. That is what our thesis has been, and it now appears it's starting to happen. So I will put a link to this article. I read it a couple times. I liked it. I'm not trying to get into confirmation bias. This is something we've been talking about since we've been doing these videos for over a year. This is what we were expecting to see. We could never actually time it. We could just report out that the activity was increasing slowly but surely. And now, as our main competition in the shale space in the United States appears to be rolling over, it appears that now offshore will see a resurgence over the next 3 to 5 years. And I believe that 5 to 10 times results in some of these companies are going to be achievable. Now, another thing I wanted to point out, it's hard to see here. I'm going to keep talking about this as appropriate, but the everything bubble continues. It's hard for me to get this entire graph in here, so I'll put a link to the tweet that this was on. What I want to show you, though, is that just about, I cut the thing off the top. It's like over 80% of S&P sectors are now breaking historical valuations. And you can basically see it over here. Here's where the tech bubble, we talked about historical percentiles. You got the tech bubble, which was in 2000, 2001, 1999, 2000, housing bubble, 2008, and today. And this is the percent of stocks in those particular industries that are considered overvalued. Do you see what the problem is here? Do you see what money printing does? Do you see the bubble? I mean, even when these were considered bubbles, you see the amount of overvaluation in particular industries. This is horrific. I mean, just about every industry is historically, almost all the stocks are overvalued historically, and that wasn't even the case during these other bubbles. In 2008, when the housing bubble burst, I mean, you had the stock market go down how much? 50%? You remember the tech bubble, if you're even around. Look where we're at today. I'm not saying that this means we're going to have a crash on Monday. I'm not saying we're going to have a crash this year. As a matter of fact, I think we're going to have a blow off top. With the amount of money printing that's going on, liquidity is forcing shares up. I currently do not see a catalyst to end this. My theory has been, or my suggestion, if you push me, is that the thing that will manifest will be an increase in energy prices, which will force inflation higher, which will force central banks to deal with the inflation, and that will be the catalyst. But that's not something that's going to happen in the next couple of weeks. And now, with the coronavirus knocking oil prices down, this is almost a boon. Now, if this thing gets out of control, we could have if we could have deflationary disinflation set in, and bond prices could go even lower. And they're prepared, believe me, to print as much money as possible to try to keep this thing alive. But at some point, as we pointed out before, inflation is everywhere and always a monetary phenomenon. And where price increases manifest is the question. And currently, price inflation, or price increases, if you will. I don't want to conflate the word inflation. Price increases are because of the inflation of the money creation is manifesting in higher asset prices to the point of being beyond the pale. Now, at some point, this thing's going to blow up, and we are going to have a really bad reckoning. But as I've talked about, I think a lot of that's going to be in the high yield bond markets and the bond market itself. We're going to make a tremendous amount of money there, folks. It's going to be life-changing wealth. And right now, there's no indication that the bond market is in any distress. I keep followed on a weekly basis. Nothing's happening, except for more money keeps going into it. And the spreads between high yield and treasuries continues to shrink. Okay, we've talked about that before. That's the first place you're going to see when the economic conditions deteriorate. That's where you will see this start to manifest, because what happens as economic conditions erode or corrode, then these marginal zombie companies can't make their interest payments, and it's going to start manifesting itself in lower bond prices. But we haven't seen that yet. So I just wanted to point this out to you, that how dangerous and precarious this situation actually is. And we have certain indicators that I'm looking at. I see what the amount of liquidity being created around the world. I just don't see it. I just don't see a situation in the near term that's going to stop it. So the good times are going to probably roll, and we're probably going to have a blow off top. We're in the midst of it, and I think that we're going to roll right into the election here, end of the year. It's in the interest of the powers that be. The president himself is the first MMT president. They're going to pull out all the stops. I think he gets reelected, and I think that's probably sell the news event. But we're a long way away from that. So we just have to look at this thing in real time and really go where the data shows us we need to go. So that's it for this week, guys. Appreciate the continued support. If you are interested in understanding or knowing how we select investment vehicles, i.e. stocks and different things that we invest in, based on the information we talk on in these videos, then I encourage you to go to the link that I'll have in the show notes and take a subscription to the Actionable Intelligence Alert newsletter. It's only $79 a year, and I think that you will be able to see how we are playing some of these companies, or playing these themes via various companies. If you are not inclined to do that, that's fine. But I would ask you to like these videos, share them, comment. That helps with the algorithm and helps more people be exposed to what we're doing here and some of the information we're talking about. So that's it for this week, guys. Wash your hands a lot. Stay off of planes. Look at this thing for what it is, this coronavirus. But I think we're going to be looking at a buying opportunity in some of the things that we're interested in over the next few weeks. So that's it for this week, guys. Appreciate it, and we'll talk to you next week.